Welcome to yet another informative episode of Market Views, a show that delivers in-depth analysis of Zimbabwe local capital markets. I'm your host, HY25, and on this first episode we do a review of our markets, and before we cap it off, we do provide an outlook for how we foresee the markets panning out in this current week. So let's dive into our weekly review for the week ending 5 September 2025, shall we? Both the Zimbabwe Stock Exchange and the Victoria Falls Stock Exchange show some paltry movements. For the week ending 5 September, the ZSE closed in the red, with the all-share index easing by 0.23%, following a 1.74% surge in the prior week. Trading activity declined as weekly turnover eased to about 203 million ZiG from 372 million ZiG, which was recorded in the prior week ending 29 August 2025. Meanwhile, on the Victoria Falls Stock Exchange, it closed in the green, with Victoria Falls Stock Exchange all-share index advancing by 0.73%, building on a 3.15% surge experienced in the prior week. Turnover also surged by 9% to 1.3 million. The interbank rate firmed up by 0.15% over the week. Delta led the turnover board with 111 million ZiG, ahead of Econet at 77 million, reversing last week's trend when Econet dominated at 299 million and Delta managed just 51 million. On the Victoria Falls Stock Exchange, INSCO dominated trading activity with shares worth 1.2 million changing hands. Simbisa, Padenga and FCB trailed behind INSCO respectively. On the prior week ending 29 August, Padenga and INSCO led the turnover board, recording 916,000 USD and 214,000 USD respectively. Foreign activity on both the Zimbabwe Stock Exchange and the Victoria Falls Stock Exchange reflected a surge in net sales. On the ZSE, foreign sales increased from 19 million ZiG to 32 million ZiG, while on the Victoria Falls Stock Exchange, they rose from $112 to 44,000 USD. In contrast, foreign purchases were minimal, amounting to just 200 ZiG on the ZSE and 6,000 USD on the Victoria Falls Stock Exchange. Against weekly turnovers of 203 million and 1.3 million on the VFX, we can see that foreign investor participation remains subdued. On the ZSE, 11 gainers were recorded over the week against 13 losers. Unifreight was the standout performer, rallying 15%, trailed closely behind by RTG and ProPlastics. On the losers list, Tenno, Tanganda and FML again closed in the red. These counters have been in the top 5 losers list for 2 consecutive weeks in a row now. The Victoria Falls Stock Exchange posted 4 gainers against 4 losers over the week. Invictus Energy was the standout performer, rallying 20%, as we have seen Invictus Energy flagship Kabra Bassa project has been granted national project status. Invictus was trailed by FCB, Caledonia and INSCO. Seedco International and Zimplo were the top losers over the week. Delta and Econet remains the top 2 counters by market capitalization, constituting 49% of the entire ZSE market cap. On the Victoria Falls Stock Exchange, INSCO is the biggest counter by market cap. Padenga, we have seen it being replaced over the week by Westprop on the 2nd position, as this gold producer keeps oscillating between the 2nd and the 3rd position. Here's our outlook for this current week and even for the other coming week. We remain bullish on equities. For instance, we've seen Econet declaring an interim dividend of 0.60 United States cents per share for the quarter ended 31 August 2025. And this brings its trailing 12-month dividend to 2 US cents per share, translating to an attractive annual yield of 15% at the current share price of 12.93 US cents. That's applying an exchange rate of 35. Equities continue to demonstrate their ability to deliver returns that outpace many other sectors. On the Zimbabwe Stock Exchange, Delta and Econet are likely to maintain their dominance in trading activity, interchanging on the 1st and 2nd position by value traded on the Victoria Falls Stock Exchange, Insco, Padenga, FCB, and Simbisa are poised to remain the most liquid counters. Thank you for tuning in. This marks the end of our first segment. Catch you on the other. Welcome to our second segment where we unpack published financials for the listed counters. Last week we looked into Mashonaland Holdings half-year results as well as First Capital Bank half-year results. Today we want to deep dive into exactly the financials released by our listed banks. We also saw NMB, CBZ and FBC publishing their half-year financials, and today we're going to sit down again with fellow analysts and then try to break it down and make some sense to you, our beloved viewers. Joining me today on set to unpack these financials is my fellow analyst, Tapiwa Nashe Kusereka. Tapiwa, welcome on set.
Oh, thank you.
Yeah, it's our pleasure to have you. So, Tapiwa, we'll start firstly by just having the overview of the banking sector. We saw all three banks reporting a growth in core income lines. That's the net interest income as well as the fees and commission income. I mean, we'll break down the proportion of each of these, but for now, we just want to know from your side, how sustainable is this shift away from the reliance on valuation gains that we've been experiencing in the prior years due to the state of our Zimbabwean environment?
Well, yeah, I believe that nowadays banks in Zimbabwe are doing well in terms of their business model in reverting to their core business. For example, an increase in lending rate and an improvement in terms of income from commissions and fees, which means right now they are no longer relying on volatile source of income, for example, from forex trading. So yeah, I do believe that those sources of income, which are now the bank's main focus of lending and interest, together with fees and commission, is quite a stable source of income. But my worry now is if they over-rely on those sources of income, most probably they are going to caught away, especially in terms of concentration risk. For example, in lending, they need to diversify their lending system to different sectors. For example, if they rely mainly on lending to agriculture, mining, or whatever, they are going to be caught unaware through concentration risk to certain sectors. But I believe those are a very sustainable source of incomes to banks, especially net interest income.
Right, thank you. I think we'll actually deep dive into it as we look at these banks individually. It's an interesting point that we've highlighted there. But still on that overview of the banking sector, NMB and CBZ, they have their functional currency in USD. And I'm sure, I mean, just for the benefit of our audience, by the functional currency, this just simply means their operations, right? A greater chunk of the portion of their operations are now denominated in USD. And the reporting currency is ZWG, which is the seed, right, for regulatory purposes. Do you foresee the functional currency becoming ZIG anytime soon? I'm asking that because we've seen the central bank, which is the banker to the banks, actually instructing banks to return back to their core business of lending. And a lot of banks, as they've been lending in USD. And we've seen minimal lending taking place in the local currency. But for this duration, maybe we can say from January to date, we've seen, I mean, stability of the ZIG and the parallel premium largely being flat or largely being stable. Do you foresee this functional currency, I mean, reverting to ZIG and Tenson?
Yeah, I believe in the short run it's not feasible to transition from US to ZiG as functional currency, because what it means is that most of the transaction, the cost structure and the source of revenue and also the source of funding, it's mainly in United States dollar. But if the absorption of ZiG in terms of transaction, in terms of cost structure, in terms of funding increase, automatically in the long run, it might be possible for those banks to move from US dollar to ZiG as their functional currency. But as long as the majority of transaction, cost structure, funding source is impregnated with United States dollar, surely due to even IAS 21, it prohibits those banks to report in ZiG as their reporting currency. Because what it means right now for them to report in ZiG, it's only because it's mandatory and it's a requirement by the regulator to report in ZiG. Not necessarily the ZiG is their major currency in terms of trade.
Okay, thank you. That's actually a good one. Okay, given the shift by some of the banks in the USD, like you have alluded to, you're an analyst. I mean, how are you navigating, interpreting the results, presented in ZiG and USD?
Yeah, as an analyst, I think we believe in stability. We need something which is stable, which is not prone to volatility. And automatically, for all financial ratios or financial numbers to make sense, we need to analyze financials in terms of United States dollar, because if we use the ZiG, which is prone to macroeconomic volatilities or macroeconomic issues, surely we end up misrepresent the position of the banks or any company in Zimbabwe. So for us to make a meaningful contribution to decision makers, automatically we need to look into those numbers based in United States dollars and convert those reporting in ZiG to United States dollars to make sense.
Thank you. Okay, now let's look at the operational efficiency of these banks. The cost to income ratios of the banks that we are looking at, they diverged sharply. CBZ had cost to income ratio of 56%. FBC, we saw it surging to 66% from 32% from the prior year, as the bank is now trying to restructure, right, into its core business of lending. NMB saw the cost to income ratio actually spiking to 84% due to restructuring and high expenses. What does this tell about the operational strategies from these banks?
Yeah, comparably, if we look at those three banks, it seems as if CBZ is on the stabilization mode, and FBC is gaining momentum in terms of cost restructuring, and
the asset quality.
Exactly. And in terms of NMB, yeah, it seems as if it's undergoing a massive transformation in terms of their
digitalization.
Yeah, exactly. So yeah, I believe these three banks are on the different stage or different phase in terms of a optimization curve. So they're in the different phase.
Okay, let's look at these banks individually, starting by CBZ. Non-interest income was very strong at I think around 1.9 billion ZiG, whilst interest income stood at only 973 million, right? That's close to half of non-interest income. Should investors be concerned about the over-reliance on transactional fees in a tight liquidity market like ours?
Yeah, if those banks continue to rely on non-interest source of income, for example, in terms of transaction volumes, for example, over-reliance on fees from transactions, yeah, given the state of our economy in terms of liquidity provision, we are potentially likely to face some challenges in terms of improving those transactions. So yeah, it depends with the frequency of transactions in the entire economy. If the frequency drops automatically, they are going to face some challenges. Exactly. So I believe that the investors should be concerned to see banks mainly focus on
financial intermediation as business lending.
Exactly.
All right. Okay, CBZ reported a profit after tax of 868 million ZiG, up from 656 million ZiG. How much of this resilience is due to restructuring and cost optimization versus real revenue expansion?
Yeah, I believe CBZ is doing well in terms of operation efficiency. They're a little bit efficient. They're able to curb those fluctuations in terms of operation cost. So I believe it's for them, yeah, it's sustainable, and they're likely to increase in terms of their numbers for net profit after tax in the coming 6 months. So yeah, it's manageable for them, and they are well able to maintain that upward trajectory in the coming.
Let's move to FBC. We saw credit impairments jumping from 16 million to 112 million. As we have said, they are now trying to improve the asset quality by returning back to their core business of lending. I mean, how mature is this impairment in your view, and does it affect or reflect the broader asset quality issues in this sector?
Yeah, I believe in English terms of impairment is a bit worrisome, and it's a red flag in terms of the asset quality of the bank, because it reflects somehow. Maybe we need to look into numbers like non-performing loans to have a clear view of the asset quality they have on their books. But we need to be very worried in terms of that significant jump in terms of impairment.
Okay, you know, there is this one thing which is interesting. You saw, like I said, before, that banks like CBZ and NMB, they've got a functional currency in USD.
Yeah.
But FBC, its functional currency, it's ZiG.
Yeah.
But taking into account that its functional currency is ZiG, we are actually seeing, when you read their half-year financials, the group is actually pursuing external lines of credit with, think more than 50 million USD. Why? Because the group is trying to diversify its funding. As we have seen, deposits that were taking place in the half-year period, they were just mainly transitory in nature. And we can say, we haven't seen that trend as yet of depositors, being comfortable in depositing their money in the bank for some time, but it's actually transitory in nature. So, in your view, how crucial is this funding diversification for the future growth, and what risks possibly comes with it, taking into account that its functional currency currently is ZiG?
Yeah, I believe it's an advantage to the bank in terms of diversifying their source of funding, and they are not going to run dry in terms of funding, because if they have somewhere to source, given that our local environment is not good for, like what you mentioned, that depositors are not willing to deposit their funds. Yeah, automatically, if they have that source of external finance, they're able to stabilize, they're able to meet what they need to balance their asset and liability management, to grow their asset side through maybe lending to different sectors. So I believe that's an advantage to a bank. But yeah, it comes at a risk. For example, foreign exchange risk, foreign exchange exposure in terms of fluctuation in terms of exchange rate. That one automatically will affect them in terms of their balance sheet, especially on net losses and net profit, currency translation, etc.
Okay. Now, the last question on FBC. We saw profit after tax. It dropped 22% to 915 million, largely due to valuation gains, right? A decline, like we've said, that the management, it actually caused this a deliberate reconfiguration. I mean, as they are returning back to their core business of lending. Do you see this as a strength, a quality of earnings, or a weakness in terms of erosion of profitability?
Yeah, I believe it's a strength since it's a part of their strategic restructuring in the foreseeable future. They are able to build upon that restructuring strategy in terms of their financials, and I believe that they are creating capacity for the future growth and future profitability. So automatically they are going to benefit through that restructuring in the foreseeable future.
Okay. Now, on the last, bank, let's look at NMB. The loan book grew by 18% to 3.4 billion, mainly funded by, again, foreign lines of credit. How secure and scalable are these facilities in our current macroeconomic environment?
Yeah, I have mixed feelings on that, given the state of our economy and the environment surrounding us. Yeah, it's a good move to have all those lines of credit to fund them and for them to be able to expand their loan book, which is the other side of their balance sheet. But like what I said on the previous bank, the risk remains the same of that foreign currency exposure. They are highly likely to face a foreign currency exposure, and the exposure also is going to be affected with the monetary policy team.
De-dollarization.
Exactly. So they are likely to face some challenges from the monetary policy, and that challenge will surely affect the performance of the bank in the near future, in tandem with the proposal of that 2030 vision of transitioning from US to SIG. So yeah, it's a risk.
Okay, that's interesting. So, okay, the last question on NMB. NMB is pushing aggressively into digital banking and fintech. How does this differentiate NMB from its peers in terms of regional growth, potential expansion?
Yeah, I do believe that NMB is on the high drive to digitalize, and they are under a massive digital transformation, which is a beneficiary for them, especially in terms of regional expansion. They have a cutting edge in terms of technological absorption, and that move is going to outcompete other local banks which are lying idle in terms of investing in those digital transformation. For now, it might affect the cost structure of the bank, but it comes with the benefit in the long run in terms of making profits and appealing to even investors and clients at large.
Okay, so this is going to be just an open-ended question for you as we conclude.
Yeah.
Looking at our banking sector, I just want to get the sense of your views. Ordinarily, banks, their core business is financial intermediation. That's getting some money from savers and advancing those money to the deficits or to the borrowers. And we've seen a lot of Zimbabwean banks deviating from that core business. Why? Because of the currency stability. Because for financial intermediation to take place, currency stability has to be imperative, right? And we've seen a lot of banks even actually, making much of their revenue from non-funded income. But like I've said, we've seen the ZIG being fairly stable from January to date in terms of the parallel market premium. What sense are you getting? Do you, looking at the banking sector in general, do you foresee an improvement in lending activity? Do you foresee the line items was like we've seen even for CBZ, the greater portion of their revenue, it's actually on fees and commissions, right? Non-funded income. Do you foresee the lending, appetite increasing in terms of our banks? Do you foresee this being a gradual process or a quick process? Just possibly share your views as we conclude.
Yeah, from economics point of view, I don't think it's feasible given that the marginal propensity to save in our country is very low given the state of our economy. We are saving very little. Like what you mentioned previously, even deposits are very low. So banks, they left with nothing to invest or to lend, because we need citizens to save their money through banks, and banks use those funds for investment through lending. So as long as our saving appetite is that low, most probably the banks will face an uphill in terms of the lending activities, and I'm sure they will continue to rely on other lines of credit, like what you said. They are now relying on foreign lines of credit and refrain from the local source of finance for lending. So yeah, I believe we are going to face.
But in a gradual process.
Exactly, yeah.
Wow. There you have it, viewers. From the conversation that I was having with Tapiwa, here's some of the things that I picked. That for financial intermediation to take place, trust is key. Once trust has been gained by the general population, then we start to see people trusting the banks by depositing their money, whether be it for short term, medium term. Then banks now can have that propensity to then on what lend. Because if I were to look at our banks, I think it's only First Capital Bank which is doing quite fairly well in terms of attracting deposits as well as going on lend. But of course, yes, it can happen if the ZIG is to continue being fairly stable. It's going to be a gradual process, and we're going to see a lot of banks onboarding on the same ship as First Capital Bank has been doing. So thank you so much for tuning in. Please do share your views and your thoughts. Would actually want to hear what are your thoughts. Market Views is a weekly show every Monday at 3 p.m. Do sure to join us on the coming episode next week. For now, allow me to thank my guest today, Tapiwa. Tapiwa, thank you for being with us today.
Oh, welcome, bro.
Okay. So thank you. We do wish you a fruitful week. Please do enjoy the rest of your day and take good care. For myself, my guest Tapiwa, and the crew behind the scenes, it's bye for now.